A lot of people, once they reach a certain age, would rather help their children and grandchildren now with a house deposit, with the grandchildren's education, with a bit of breathing room while they're young, than leave everything tied up until they're gone. It's a lovely instinct. But it comes with a worry attached. Will the taxman take a chunk of whatever I give? Will inheritance tax catch it? So let me start with the good news, because it's better than most people think. There are gifts you can make right now that are completely free of inheritance tax. No waiting, no catch, no clock ticking. And for the larger gifts, there's one simple rule that, once you understand it, takes most of the fear away. The trouble is that the rules are widely misunderstood, and there are a couple of mistakes that can pull a gift you thought was safe straight back into the tax net, including the classic one of signing your house over to your children. This matters more now than it used to. Inheritance tax is charged at 40% on the part of your estate above the tax-free threshold, and that threshold, £325,000 per person, has been frozen for years and is frozen for years yet to come. On top of that, from April 2027, unused pension savings will start to count towards your estate too. So more ordinary families are being drawn into inheritance tax than ever before, which makes sensible, legal gifting genuinely worth understanding. So here's how we'll go through it. First, the gifts you can make immediately, with no 7-year wait at all, and there are several, including one generous rule almost nobody uses. Then, the 7-year rule for bigger gifts, and the part of it people get wrong about so-called taper relief. Then the 2 mistakes that can undo all your good planning, including why giving your home to your children while you still live in it doesn't work. And finally, how to keep a simple record so your family isn't left untangling it later. Let's begin. Just a quick word first on how inheritance tax actually works, so the gifting makes sense. When you die, your estate, your home, savings, possessions is added up. Everyone gets a tax-free threshold, called the nil rate band, of £325,000. There's often an extra allowance, the resident's nil rate band, of up to a further £175,000 if you leave your main home to your children or grandchildren. Anything you leave to a husband, wife, or civil partner is completely free of tax, and a couple can pass their unused allowances to each other, which is why, in the right circumstances, a married couple can pass on up to £1 million before any inheritance tax is due. Above the threshold, the rate is 40%. So the whole point of gifting in your lifetime is to bring the value of your estate down, sensibly, while helping the people you love. Now to the gifts you can make straight away, free of tax, with no 7-year wait. There are more of these than people realize. The first is your annual exemption. Every tax year, you can give away £3,000 completely free of inheritance tax to whomever you like, one person, or split between several. And if you didn't use last year's £3,000, you can carry it forward just 1 year, so you could give £6,000. Remember, this is per person, so a married couple can give £6,000 a year between them, or up to £12,000 if neither used last year's. That alone, year after year, moves a meaningful sum out of your estate. The second is small gifts. On top of that annual exemption, you can give as many people as you like, up to £250 each, every year, tax-free. Grandchildren's birthdays, a little help here and there. As long as no single person gets more than £250 under this rule, you can spread it as widely as you wish. The third is wedding gifts. If someone close to you is getting married or entering a civil partnership, you can give a tax-free wedding gift up to £5,000 to your own child, up to £2,500 to a grandchild, and up to £1,000 to anyone else. Give it around the time of the wedding, and it's exempt straight away. And the fourth is the big one that almost nobody uses, and I really want you to hear it, because it can be worth far more than all the others. It's called giving out of your surplus income. If you have more regular income coming in than you actually need to live on, and plenty of pensioners with a good pension do, you can give that surplus away regularly, completely free of inheritance tax, with no upper limit and no 7-year wait. The conditions are simple, but they matter. The gifts have to come out of your income, not your savings. They have to be regular or habitual, not a one-off. And they mustn't leave you unable to maintain your normal standard of living. So if your pensions comfortably cover your life and leave you, say, £400 a month spare, you could pay that to a grandchild every month towards their rent, their studies, a junior pension for them, and it's immediately outside your estate. The catch is that you must keep a record showing it genuinely came from surplus income so that your executors can prove it later. Do that, and this is one of the most powerful tools there is. Let me show you how this comes together with one couple. Meet Edward and Joan. Edward is 74, Joan is 72. He had a good career as an engineer, with a solid works pension, and between that, their state pensions, and some savings, they live comfortably and have money left over each month. They've got 3 grandchildren, and they'd love to help ones at university. One's trying to save a deposit for a first flat. They've also been quietly anxious that their estate, with the house, will tip over the threshold and leave a big inheritance tax bill. Here's what they can do, all of it legitimate, and most of it tax-free immediately. Between them, they can give £6,000 a year under their annual exemptions straight to the grandchildren, out of the estate at once. They can give the university grandchild a regular monthly amount out of their genuine surplus pension income, say £300 a month, and because it comes from income they don't need, it's immediately exempt, with no limit and no waiting, as long as they keep a note of it. They can use small gifts and a wedding gift when the time comes. And for the bigger help, Joan wants to give the deposit-saving grandchild a lump sum of £50,000. That's where the 7-year rule comes in, which we'll get to in a moment. But here's the mistake Edward and Joan very nearly made, and it's a common one. They'd half decided to simply sign the house over to their children now to get it out of the estate. As you'll see shortly, that wouldn't have worked the way they hoped and could have caused them real problems. We'll come back to it. So let's talk about that £50,000 deposit and bigger gifts generally, because this is the 7-year rule everyone has heard of and few understand properly. When you give a larger gift to a person above the exemptions we've just covered, it's what's called a potentially exempt transfer. The word potentially is the key. If you live for 7 years after making the gift, it falls completely out of your estate. No inheritance tax on it at all, however large it was. That's the rule in a nutshell, and it's why people are encouraged to make big gifts sooner rather than later. The clock only helps if it has time to run. If you were to die within those 7 years, the gift doesn't escape. It's counted back in and set against your £325,000 nil rate band. And here's the part people get wrong, so listen closely, because it causes real confusion. Many believe that after 3 years, the tax on a gift starts reducing, thanks to something called taper relief. Taper relief is real, but it only reduces the tax on gifts that go above your nil rate band, and only the tax, not the value of the gift. So for most ordinary gifts, which sit within that £325,000 band, taper relief does nothing at all. If you die within 7 years, the gift simply uses up part of your tax-free band. It's not that a chunk of it becomes tax-free after 3 or 4 years, that's the myth. For Joan's £50,000 gift, the practical truth is straightforward. If she lives 7 years, it's entirely free. If she doesn't, it uses up part of the couple's tax-free allowance. Either way, it was a sensible thing to do, but now they understand exactly how it works. Now, the 2 mistakes that can undo good planning, because avoiding these matters as much as making the gifts. The first is the one Edward and Joan nearly made, giving something away but carrying on benefiting from it. This is called a gift with reservation of benefit, and the classic example is exactly theirs, signing your house over to your children while you carry on living in it. In the eyes of the taxman, you haven't really given it away because you're still enjoying it, so it stays in your estate for inheritance tax, and the 7-year clock never even starts. The only way to make a gift of your home work is to move out or to pay your children a full market rent to live there, which brings its own tax and complications. And there's a second danger to that idea. If you give your home away to dodge future care fees, your council can treat it as deliberately depriving yourself of assets and count it anyway. So please, never sign over your home without proper, professional advice. It very rarely does what people hope, and it can cause real trouble. The second mistake is gifting away too much and leaving yourself short. It's a wonderful thing to help your family, but you must look after yourself first. You may live another 20 or 30 years. You may need money for care or for your own comfort and independence. Never give away so much that you'd struggle later or have to go cap in hand to the very people you helped. Generosity should come from your surplus, not from your security. So here's what to actually do, simply and in order. First, use your annual allowances. Every year they don't carry over for long, so a gift you don't make is an allowance you lose. The £3,000 annual exemption each, the small gifts, the wedding gifts when they arise, these are immediate, tax-free, and the easiest place to start. Second, if you genuinely have more income than you need, consider setting up regular gifts out of that surplus and write down what you're doing and where the money comes from, because that record is what makes it work. Third, for bigger one-off gifts, understand that the 7-year clock is your friend, and the sooner you start it, the better. If a large gift is part of your thinking, there's rarely a reason to delay. Fourth, never give away your home while you're still living in it without proper advice, and never give away so much that you leave yourself exposed. And fifth, keep a simple written record of every gift, the date, the amount, who received it, and which exemption it falls under. Tell whoever will be your executor where to find it. For larger estates, an hour with a good solicitor or a regulated financial advisor is money well spent, because the savings dwarf the cost. So let me leave you with the heart of it. You can help your family now, far more than most people realize, and a great deal of it is free of inheritance tax the moment you do it. Your annual allowances, your wedding and small gifts, and especially the regular gifts you can make out of income you don't need. For anything bigger, the 7-year rule is simple once you see it clearly, and starting early is what makes it work. The mistakes to avoid are keeping a benefit from what you've given, giving away more than you can afford, and leaving no record behind. Get those right, and you can do exactly what you wanted in the first place. Look after the people you love in your own lifetime, where you can see the good it does. So do share this with anyone who's thinking about helping their children or grandchildren, or who quietly worries about inheritance tax. A clear understanding of these rules could let them give more, keep more, and avoid a costly mistake, and that's a kindness worth passing on. I'll see you next time.